Hello, sir. We are live.
Okay. Professor Kriti, should we start?
Sure. Then shall we start? Karan?
So, good evening, everyone. It is my absolute pleasure to welcome you all to the fourth session of guest lecture at CCIT. CCIT is Center for Comparative and International Taxation under the aegis of Jindal Global Law School. Today, we have with us Mr. Suchint Majumdar, the partner at Deloitte Haskins and Sells LLP, specializing in international tax and transfer pricing. I would now welcome the speaker to start with the presentation. Over to you, sir.
Thank you very much, Aditya, and thank you, Kriti, for the warm invitation. I have with me my colleague Karan, who's been the architect of the slides that will be presented, and together we will take you through the contents of this mini workshop, as it were. The title of which is Foundations of International Transfer Pricing. Just to set the context, the objective is to provide you with enough of a flavor of transfer pricing, both internationally and in India, with a certain set of learning objectives. And these learning objectives are to be acquainted with the genesis of transfer pricing, both globally and in India. The identification of transactions and associated enterprises that would trigger a transfer pricing event, the awareness of methods of transfer pricing, to be able to relate to multiple and parallel legislations that have a related party element, and finally to understand the triggers of controversy and appreciate the aspects of prevention and resolution of controversy and disputes in the area of transfer pricing. So with that set of objectives, we'll turn to what the concept of transfer pricing is about, and go into the genesis of where this law emanates from. Transfer pricing in a relatively simplistic concept refers to the occurrence of transactions between related parties, and looking at these transactions from the lens of what unrelated parties would have dealt with had this relationship not existed. The fact is that relationships between parties tend to color the manner in which transactions take place. And the terms and conditions of these transactions get influenced by the relationship between the parties. What transfer pricing seeks to do is to, quote unquote, remove that element of relationship so as to make a transaction a quasi-transaction that would have occurred had these relationships not existed, and thereby determine what the transaction would have been had the parties been transacting at arm's length. Now, in many cases, especially in relation to tangible property, when I say tangible property, I mean everything from extracted materials such as metal ores, all the way through semiconductors, any forms of tangible property. This is easier than it is with respect to intangible property. And intangible property are things like know-how, software, and other forms of maybe even media that are necessarily hard to replicate, as it were, or construct through raw materials and through components that otherwise would apply to tangible property. And so it is easier to deal with tangibles than it is with intangibles, and it is again easier to deal with tangibles than it is to deal with services. But the short point is that all of these transactions, whether it is to do with goods, services, intangibles, financing transactions, are all the subject of transfer pricing provisions between associated enterprises. And associated enterprises really mean related parties. So we substitute a transaction that happens between related parties to be as if it occurred between unrelated parties, and then find out what they may have charged in respect of such comparable, uncontrolled conditions and transactions. So with that, we'll turn to the next slide. And what happens is that transfer pricing originated or takes its origins from Article 9 of the Model Convention. Now, this applies to both the UN Model Convention as well as the OECD Model Convention, and this is to give you some kind of a comparative context. The Article 9 posits that the transactions between associated enterprises should be priced in arm's length conditions, and if there are conditions that apply between related parties that otherwise would not apply between unrelated parties, then those conditions should be, let's say, taken out, and then the transaction be reconstituted as if it were between unrelated parties. It is on the bedrock of Article 9 that each country then develops its own transfer pricing provisions, but the principles around which these provisions are developed, one is on the foundation of 9, but also the methods on the basis of which, or the factors on the basis of which transfer pricing is determined, has almost invariably throughout the world remained fairly consistent, which means that we are talking of similar methods, we're talking of similar practices, and therefore to that extent, the law and practice of transfer pricing is significantly harmonized around the world, fairly similar to how there is a harmonization of customs valuation that in a sense operates almost at the opposite end of the spectrum of transfer pricing. And I say this because in the context of customs, the objective is for the customs authorities to collect as much duty as possible, which means that if you are referring to an import transaction, they would want the import price to be as high as possible. Whereas in the context of transfer pricing, you would expect that whatever you pay to a related party would normally be as low as possible, so that the in-country profit tends to be on the higher side. So that's why there is a apparent difference in the manner in which customs and income tax look at transfer pricing. But suffice to say that the methods are by and large consistent, whether it's to do with the customs law or it's to do with transfer pricing provisions, at least insofar as the provisions concerning them relative to different countries are concerned. In recent times, 2015 onwards, the OECD put out certain framework of BEPS actions. They're called base erosion and profit shifting actions, which specifically dealt, among other things, with transfer pricing provisions. So there were about 4 actions that dealt with transfer pricing, actions 8 to 10, that sought to align value creation with transfer pricing, and or with outcomes that determine determining the right price for such transactions. And action 13, which dealt with documentation. There's another action that dealt with dispute resolution and prevention, which is action 14. The UN manual is another body of literature. So there are two sources of literature that have also concurrently developed. One is the OECD transfer pricing guidelines, and the second is the UN practical manual that also provides guidance around transfer pricing, with particularly focus on emerging countries and or emerging economies and around practical situations. So with that, we can turn to the next slide. Again, this is a bit dense, but we'll go into trying to create some kind of a connector for legislation that exists in respect of OECD, Indian legislation, and as an example, USTP legislation. The arm's length principle in respect of all the three remains the same, which is that you deposit unrelated parties for related party transactions. Methodologies for determining transfer prices are also by and large consistent, except that there may be nomenclature differences. There is a method in India and the OECD that is referred to as the net margin method. This is referred to in the US legislation as being the comparable profits method, but they operate by and large similarly. The US also has certain regulations insofar as cost sharing is concerned, or insofar as services regulations are concerned. They are, in a sense, some variants of what we have in India that's more general, and what the US has is more specific. The US also has more examples than exist in, say, the Indian legislation. And often enough, the OECD regulations tend to follow what the US sets out as being the, let's say, the beacon or the bellwether for transfer pricing law. Although increasingly, there has been a lot more consensus between countries around transfer pricing law, so that currently a lot of transfer pricing law that is enshrined in the OECD guidance is the product of what is referred to as the inclusive framework, which is about 140 countries that have come together and sought to harmonize laws pertaining to international tax. Things like comparability analysis are again areas where there is significant commonality, and we will get to see what comparability analysis involves. But essentially, suffice to say that it is the comparison of a controlled transaction with an uncontrolled transaction. When I say controlled transaction, it means the transaction between related parties, and we are looking at that through an unrelated party lens. There is considerable focus on documentation, and the documentation across legislation is intended to be maintained contemporaneously, which means that as the transaction occurs is when you document the facts and circumstances relating to the transaction, so that there is no question of the use of hindsight, and you're able to determine in what context the transaction took place and what assumptions and what hypotheses were used when the transaction occurred, so that people are then not second guessing what the transaction could have been had it taken place at a different point in time. There are also regulations around some regulations have something called a safe harbor, which we will get to, but that's a means of achieving certainty in the area of transfer pricing, working with some numbers that are close approximations of arm's length prices. Then finally, we also have to recognize that not only do transfer pricing provisions apply to parties as a, for example, a holding company and a subsidiary company, but they could also extend to a company and its branch office, a company and its project office that essentially is an extension of the company itself, or a projection of that company in another country, referred to as a permanent establishment, what otherwise is referred to as a place of business of the enterprise. And so transactions between the company and the place of business are also, which are typically referred to as dealings, are also the subject of transfer pricing. So with that, we turn to the next slide. This is again striking at the core of the subject. The genesis of transfer pricing in India particularly is with reference to provisions that were enacted in 2001, which was about a decade after liberalization. And it was a fairly conscious move because if you think of the time when liberalization took place, it's not to say that transfer pricing never existed in Indian legislation. It always used to exist in a very non-decrypt form or in a very abstract form, which was just to say that transactions between related parties should be as if they were between unrelated parties, but with no particular detail. And so as liberalization took place and as companies kept coming in, investing in India, they started setting up their own transfer pricing policies absent legislation. And that meant, just to give a very rough and ready example, there were companies that, let's say, among the early entrants in India were companies that did software and services. Easy to set up a software company. The provisions of the software technology parks of India were relatively more liberal. And so among different sectors that were sunrise sectors, IT became one that particularly took stronger hold on many companies that were setting up shop in India. And these companies, in the absence of any guidance, started working on cost plus 5%, which meant they would say, okay, what's our total cost? Invoice at cost plus 5. What that 5 did was it in a way got them some profit. It also got them liquidity to be able to pay for their expenses. And so if I incurred a cost of 100, I would get a revenue of 105. And effectively, that was how I was able to continue existing as a company, but with no regard to the tax liabilities arising from it. Whereas what transfer pricing did was that it said, oh, but if other companies that are Indian companies are operating at, let's say, cost plus 15, cost plus 20, meaning they're making profits of 15-20% on their cost, then the answer of 5% is not arm's length, meaning it's not what you would do if you were not related. And so thereby transfer pricing provisions got enacted to make sure that companies would report the right amount of profits and therefore pay the right amount of tax. We've seen over the years that in the initial days, so let's rewind back to 2001, and almost that this prevailed almost till about 2010 or 2012, many of these companies did enjoy tax holidays. And so whether they were reporting cost plus 5 or cost plus 10 didn't make any difference. They were still enjoying the holidays. But because of the manner in which provisions were written out, companies started to increase their transfer prices to a point where that cost plus 5 in 2001 has now by and large settled at anywhere between cost plus 15 and cost plus 20. So you can already see in the 20 years of the existence of the law, just as taking IT sector as a frame of reference, there's a considerable amount of uptick in the profit, as well as thereby in and when you sort of think about it in the context of one, the tax holiday is going away, and two, the volumes of business that have been taking place in the IT sector, that already translates into significant earnings that these companies have been reporting. So that's the difference in a sense between not having transfer pricing back in 2001 to the current state. But that's really the reason why provisions have been being introduced, not just now in India, but countries like the Middle East have started introducing these provisions. And after India, many countries, particularly in the Eastern Asian region, have also been introducing and administering transfer prices. So I think the other thing is that, and we can turn to the next slide, but the other thing is that there are different rates of tax, there are different types of transactions, and therefore these provide opportunities for companies to manipulate, as it were, their transfer prices with a view to decreasing their income tax liability. So let's take the example here, wherein we have a parent company that is situated in India, a subsidiary company which is situated elsewhere. And what this company does in the overseas country, which is, let's say, a tax haven, is effectively only serve as a buy-sell enterprise, buying from India at a low price and selling to the third-party customer at a high price. And here we're taking the third-party customer to be somebody outside of India. So think of an Indian company selling to a BVI or a Cayman Islands entity at a significantly reduced profit. And then in turn, the BVI or Cayman entity, which is not taxed on its profits, is then selling to the end customer at a significantly higher profit, and thereby recording, in our example, a profit of 20 in India and a profit of 60 in the BVI. So to explain this again, the Indian company incurs a cost of 60, generates a profit of 20, and sells at 80 to the Cayman entity. And thereby the Indian company that has to pay tax is paying tax on 20, and effectively at 30% is paying 6 of tax. The Cayman entity is buying at 80, which is the transfer price from India to BVI, and is in turn selling to the third-party customer at 140, and thereby generating a profit of 60 in that jurisdiction, which is subject to no tax at all. Which means that the total tax liability is only 6 on an effective sale of 140 with a cost of 60. Now, when you think of what that would have done in an unrelated situation, in an unrelated party context, where market prices were the determinant, it would have meant that the Indian company would have sold it directly to the third-party customer, generated a profit of 60, on which the tax would have been 18. So there's clearly a profit shifting that is arising, resulting in tax savings of 12. And this is the abuse that transfer pricing is seeking to curb by saying that the entity that is the distributor, in other words, the subsidiary company, is enabling the shifting of profits, which is now today referred to as base erosion and profit shifting. So there's base erosion to the extent of 60, and there is this profit of 60 that is being shifted, as it were, to the other low tax jurisdiction, resulting in an overall tax minimization that smacks of a tax avoidance. And it is therefore, in order to curb this kind of a practice, that there's much more focus on the transfer pricing provisions. So if we go to the next slide, this is the set of the rule framework or the rule structure for transfer pricing. And while, as you can see, it's a very short code. If you think of the Income Tax Act, and that has over 300 sections, this is a fairly compact rule set. And this rule set is, in a sense, only the tip of the iceberg, because all of the guidance or the code that underlies this rule set lies in the OECD guidance or the UN guidance. And the OECD guidance in 1995, which 1979 was the first set of rules that came out by the OECD. It got revised in 95, and in 95 the entire OECD guidance was about 300 pages. Today it's about 1,000 pages. So you can see how much has been added by the OECD over time in terms of literature. Also, what has happened is that the frequency in which the revisions take place has also been increasing. So 1979 first set of rules, 1995 the revision took place, then 2010, then 2015 with BEPS, then 2017 And then now we have something which is along the lines of Pillar 1, Pillar 2, and the UN manual also got revised in 2021. So you're seeing much more frequent revisions to transfer pricing or profit allocation related provisions, which just means that there's more emphasis on transactions, on the concept of how profit shifting could take place, and a general consensus that there need to be mechanisms in place to prevent tax avoidance through pricing structures. With that, we'll turn to the next slide, and we'll go into two of the key components that determine transfer pricing provisions. One is to do with associated enterprise and the other is to do with international transaction. So an associated enterprise is significant because it is a transaction between associated enterprises that is the subject of transfer pricing. So therefore, associated enterprises are the two or more parties who are the subject of the transaction, or who are the parties to the transaction, and the subject of the transaction is what is referred to as the international transaction itself. So anybody is, the term enterprise is very, very widely defined, and therefore practically any activity can get captured, any person who's doing any kind of activity can get captured under the expression enterprise, and therefore when we talk about a person, it can be anybody from a human being all the way to a form of any incorporated or unincorporated entity, and it could extend to joint ventures, it could extend to partnerships, it could extend to any inanimate objects as well. But as long as that a particular enterprise is performing any activity relating to goods, relating to services, financing, and through any of its units or divisions, that is sufficient to get it captured within the ambit of the expression enterprise. And it also includes the permanent establishment of the enterprise. In other words, like we spoke earlier, a branch or a project office or even a service permanent establishment, which means that you have deputation of personnel and those personnel are carrying out activities. That could also form a permanent establishment, and then dealings between the head office and the permanent establishment would be the subject of transfer pricing. So this is one expression that's of relevance. The second is that of, again, continuing with associated enterprise. There are two parts to it under Indian law. One is at a concept level. The concept level is that an associated enterprise has to participate in management, control, or capital. This could be directly or indirectly. And the second is that there are certain sets of deeming fiction, which means that in certain situations alone can enterprises be regarded as being associated enterprises. For instance, 26% participation in capital or voting power, 10% in the context of loans or borrowings, dependency for intangibles, participation in board in board positions, participation or representation in the governing body to the extent of more than 50%. So there are a number of such deeming provisions that would enable companies or enterprises to be regarded as being related. And it is only if any of those categories are satisfied does a company or does a party become an associated enterprise of another. Absent that, there is no associated enterprise relationship. But having said that, these certain categories are very wide, and therefore it is very likely that a certain category will be triggered for companies or for enterprises to be regarded as being associated, and therefore provisions of transfer pricing would become applicable to them. Again, the important point is therefore 92A1 and A2 have to be read together and not in isolation, which means that it is not sufficient that a loose form of management, control, or capital is identified, but it has to be very specific through the deeming provisions of the categories in which such relationship is actually constructed or achieved. Now, it's something useful to note that normally transfer pricing applies only to international transactions, and that's logical because within the country there would be no objective to shift taxes or shift profits. In certain instances, though, there are specified domestic transactions that are also the subject of transfer pricing. And these specified domestic transactions are typically between tax holiday units and non-tax holiday units. And that's logical because if a company, for instance, a new manufacturing company gets a concessional rate of tax and it deals with or transacts with another entity which does not have the concessional rate of tax, then there is obviously a motivation to keep more profits in the low tax entity and lesser profits in the high tax entity. And therefore, to curb this abuse, there's a provision for domestic transactions also. There's of course a higher threshold for which this would apply, but it's just useful to keep this in mind. Now we get to the next one, which is fairly interesting, which is to do with the international transaction. Now, it's what's of note is that every conceivable transaction is covered, and this extends to tangibles, intangibles, services, all forms of financing, cost allocations, business restructuring, which means that, for instance, a manufacturing organization has been converted to a distribution. That's a business restructuring. Or a company that was manufacturing under a license is now becoming an entity that is manufacturing under contract. That's a big case of a business restructuring. So every kind of conceivable transaction gets caught under the ambit of international transaction, as long as it is a cross-border transaction. And only in certain instances do domestic transactions also get covered under some kind of a deeming fiction, whereby if you posit a unrelated party between two related parties, then it's seen as an artificial means of using an unrelated party as a colorable device to avoid transfer pricing. In such situations, again, a transaction between unrelated parties would also get caught within the ambit of transfer pricing, whether it is domestic or it is international. But I think what is of relevance to note is that the ambit of international transaction is therefore very wide. And therefore, when you think of applying transfer pricing provisions, the provisions of the methods have to be so wide as to be able to address all of these kinds of transactions. So if we turn to the next slide, we've just listed down for reference certain types of typical transactions. When we think of manufacturing, there is raw material and there's finished goods. There is, in the context of distributors, you'd have finished products that are purchased and sold. These could be in wholesale or retail. When we think of services, there could be any number of services, but they could be contract services, like you perform software development services, or they can be intra-group services, which means that somebody in the group is providing centralized functions, such as procurement, or such as management functions, or such as shared service functions like finance and HR. So a host of transactions can be covered, but in manufacturing, remember that we will also have potentially some intangibles. So for instance, you may have a royalty being paid for technology. In the context of a distributor, you might have a trademark fee being paid for the use of the brand. And then in the case of services, you may have some intangibles that are deployed to be able to render the services, such as, for instance, maybe some technical services provided in order for you to render those services in turn. So there may be or some know-how or some software that is used for rendering the services. So again, the idea is any of these transactions then gets into the ambit of transfer pricing to then identify which method and how do you establish that each of these transactions then is dealt with at arm's length. Sometimes it can be aggregated. So we, for instance, let's say that you purchase raw material and then you also pay out a royalty, and then you may have sales to third parties. Then the profit that arises from this set of transactions, which essentially involves purchase of material from the related party and the royalty paid to the related party, will that profit that arises is then compared to the profit that would arise in an unrelated party transaction, which entails similar raw material and similar know-how, or at least fairly similar products, or the family of products might be similar, in order to determine whether this particular transaction has been, or this particular set of transactions has been dealt with as if it would have been dealt with between unrelated parties. As we can see, this is highly a fact-specific exercise, and you see the one of the very interesting facets of transfer pricing, unlike other provisions of income tax law, is that it's highly fact-intensive and circumstance-intensive. It's not as much law-intensive. There's only so much guidance that can be provided. The rest of it emanates out of contracts and conduct. And the OECD has gone on to say that conduct is even more important than contract. So as you can imagine, this is a body of law that is highly fact-intensive and less to do with the provisions, more to do with the application of those provisions to the facts and circumstances, and therefore you could have a different answer each time, depending on how the parties have arranged their affairs. And therefore, transfer pricing cases tend to be a lot more around the facts and circumstances of the case, which includes comparability analysis, and much less to do with whether or not the provisions are triggered. From a methodology standpoint, there are 6 methods ordinarily that are used to determine arm's length price. Now, there may be some variants of these methods. We've seen in the US, for instance, that there are more methods than what are listed out, but those are just variants of methods. But I'll speak a little bit about 2 types, essentially fundamentally 2 types of methods. One is the traditional method. What I mean by that is these are methods that will get you to a price. So think of the cost plus method. The cost plus method is simply saying add up all the costs, add an arm's length profit margin. So take all your costs, find out what a comparable uncontrolled party would take as its profit margin on those set of costs, on a quasi-identical set of costs, and that's the profit margin that should be applied in order to arrive at the price at which the party should sell a product. So if I was a manufacturer and I was the controlled party, and there was another party that was an uncontrolled party, that uncontrolled party's cost structure would be taken, the profit margin would be applied, that the profit that it generated would be used, and that would be applied onto my cost structure, and whatever is the resulting cost plus answer. Let's say that the other enterprise, the uncontrolled party, had applied a 20% uplift on its costs. The same 20% would be applied on my costs, and let's say my costs were 100. Then 100 plus 20, so 120 would be my transfer price. So I would be able to get to a price on the basis of the cost plus a margin. The resale price works in reverse, which means that from the price at which I sell to a third-party customer, I back out what would have been the normal profit margin that I would have earned had I been an uncontrolled distributor, and then the resultant answer is the price that I would have paid to my associated enterprise. So it's a resale minus method in that sense. The comparable uncontrolled price method typically applies, let's say, in commodities. You buy coffee from Brazil, I buy coffee from Brazil, somebody else buys coffee from Brazil, same type of coffee. the grains are similar, that is priced at 100, therefore this should logically be priced at 100 if the timing has been about the same. So that's the comparable uncontrolled price. So in all these three methods, you're tending to arrive at a price. Under a profit method, you tend to arrive at a profit. In other words, the basis of the price is the basis of establishing that a transaction has occurred at the right price is not the price itself, but is the profit. So you would say, has let's say that we are dealing in manufactured vehicles, and we would say, how much profit should I make for the imports of components which are then converted into vehicles? And the answer would be, what would an uncontrolled enterprise make as a profit? Did you make so much of a profit? And therefore, whatever profit has been made is then apportioned, as it were, to the different components to determine if the purchase of the components is at the right price. So as long as I've made the right amount of profit, then I'm at arm's length. If I haven't made the right amount of profit, then whatever is the difference will then get loaded onto the price or subtracted from the price to arrive at the price which I would have paid to a third party. So it's profit based as opposed to price based. That's the difference between traditional transaction method and transactional profit method. One is using profit as the basis of arriving at the transfer price. The other is getting to the price itself. And then there's another method, which is a residual method, which applies, for example, in the context of, let's say, financial transactions like purchase of shares, or where you sell entire businesses. Then you may use a method that enables you to determine what would have been a price that would have been paid in comparable circumstances. Using, say, for instance, discounted cash flow, or using, for instance, methods such as relief from royalty. So there are other or comparable transactions as a proxy for the price in the absence of an actual comparable uncontrolled price. So these are the set of methods that could apply, and there may be other methods that would apply in the context of the use of other methods, for instance. But this is the set of methods that normally gets applied, of which we see the most application in the transactional net margin method. And to some extent, we see the other methods being applied, and perhaps the least used is the profit split method. Now, this is a set of steps that would determine the arm's length price, and we'll go through these fairly quickly. Like we said, it's a highly fact-intensive subject. Therefore, it is very useful to understand what is the business model, what's the business arrangement between companies or between enterprises relative to a transaction. So understanding the business model is key. This is enabled through something called a function asset risk analysis, because functions, assets, and risks interplay between enterprises to arrive at the price depending on the quantum of risk that an enterprise assumes, depending on its employment of intangible assets, depending on its intensity of functions. It has to get remunerated to that extent to a greater quantum than someone who assumes has a lesser function asset risk intensity. Thereafter, you determine what's the most appropriate method to apply in the light of the function asset risk analysis. And then you go through a process of determining the tested party. And the tested party is the party that has the least complex set of functions, and therefore which can be benchmarked, or for which you can get comparables relatively more reliably. And this often enough tends to be somebody like a contract service provider, a contract manufacturer, a low-risk distributor, somebody for whom you can get comparables without apparent difficulty or without the need for excessive adjustments. Then you arrive at the set of comparables. You then look to, in order to arrive at the comparables, you apply a set of filters. These can be, for instance, a related party filter to eliminate companies that have related party transactions. It can be an export filter sometimes to say that you want to apply if you're exporting services, then you want to try and see that the nature of the service is comparable to what you are exporting. So you might apply an export filter. You might apply a turnover filter to make sure that if you are exporting, let's say, services or goods of 100 CR, then you're not, for instance, working with comparable companies that have much lower thresholds of turnover, because turnover has an influence on the profitability. Then you look to the effect of multiplier data, because you also want to see that you're ironing out business cycles, and you arrive at a statistical range, which in India is defined as between the 35th and the 65th percentile, so that you're eliminating outliers. Then you determine the margins or the prices, make some adjustments to those. For instance, one of the common adjustments is a working capital adjustment, which irons out the differences between the company that is the subject of transfer pricing and the comparable companies, because they may have different levels of receivables, different levels of inventory, different levels of payables. And so that has an effect on the profit, for the reason that the more receivables, let's say that somebody is realizing their receivables in, let's say, 6 months, and we are realizing our receivables in 60 days. Clearly, there is an interest component that's built into the price of the party that's realizing the monies in 6 months. To that extent, they're tending to inflate their pricing for the third party, because the customer is intuitively or imputedly paying for the interest of the 6 months that the party is enjoying credit for. And then you determine the arm's length price on the basis of these steps, and then back it up with documentation. Now we turn to function asset risk analysis, and here we look to the reason why this becomes relevant is that the most appropriate method is determined having regard to functions performed, assets employed, and risk assumed. And this is where it emanates from, in the sense that the law itself under 92C or the rules contemplate the use of a functional analysis in order to arrive at in order to then proceed to doing a comparability analysis. And then it also speaks of other areas of comparability, but of key relevance is the intensity of functions, as it were. And depending on that intensity of functions, you also do comparability analysis. So the functional analysis is used at 2 levels. One is to determine the arm's length price. Now, for instance, if we think of a contract manufacturer who is simply taking over inventory of materials, converting those materials into finished products and selling back to the principal, as opposed to somebody who is a licensed manufacturer or an entrepreneur who is buying materials on its own accord, converting them, selling in the open market, and realizing market linked returns, then there is a difference in the level of risk, because and the technology that is employed, because in a contract manufacturing arrangement, someone's giving you the technology, you're doing only a conversion exercise, and the committed offtake is then taken up by the principal. Whereas if you are an entrepreneur, you would be employing the technology, you would assume inventory risk, and then you would and potentially even credit risk, and then you would sell this in the market, including the fact that it's your intangible property that's applied, and so you could potentially even get sued for the use of inappropriate technology, which would not occur in the case of a contract manufacturer. So contract manufacturers therefore take on lesser risks, perform lesser intensity of functions, and therefore tend to get remunerated less than licensed manufacturers or entrepreneurial manufacturers who have greater intensity of functions and therefore would expect to get rewarded in a greater manner. And then this then translates into the maintenance of documentation to demonstrate that this is the functional profile, and as a result of which the compensation is in line with that functional profile, because you apply filters that would enable you to determine comparables that also perform a set of functions that are similar to yours. Now, of course, you can't be absolutely certain about comparables because there's only so much information that's in the public domain. But what you get is through the basis of comparability analysis and the application of filters that tends to get you to a fairly close approximation. So components of functional analysis, we have just illustrated this. You would expect to see functions that range from research and development to then, and this we've given it in a sequential form. So it starts with R&D, then goes into designing, then it goes into procurement of raw material, then it goes into the actual manufacturing, and then it goes into marketing and distribution. So think of it like a value chain. When you think of assets employed, there are tangible assets. Most tangible assets can be easily valued because they have reference to market prices. Intangible assets are far more difficult to value, depends on a host of factors, including how rare the particular technology is. They could extend to licenses, brand names. So think of Nike, for instance, think of Apple, for instance, think of which Apple's a combination of both brand and technology. And therefore, you could have something that's fairly commonplace all the way to something that is extremely esoteric. And then things like not so apparent assets such as distribution network. In addition to the brand, you may have a host of channels of distribution which also comprise your strength, and that's your assets in an intangible form. And then your entire talent base walks out the door every day, but is in a way contributing to your value creation. And then finally, the risks that are of different nature of risks. So there's market risk. When you're exposed to the market, that's a market risk. There's inventory risk because of the stock that you hold, capacity utilization in the context of how much of your labor force is utilized, how much of your machinery, plant and property and equipment is utilized. That's capacity utilization risk. It would vary in the context of a contract manufacturer or a, what is called as a toll manufacturer, where you might be fully covered for capacity utilization, all the way through a entrepreneur who may have 100 orders, may have 10,000 orders, and there could be situations of highly low or very, very significant underutilization of capacity, all the way through stock out situations, which can mean loss of profit potential if you're stocked out. So you can have two extremes there. Product liability, because of the technology that you own, you also have to offer warranties, and therefore that could result in payouts on account of liability. Credit and collection risks, if you're dealing with unrelated party customers, and foreign exchange risk, depending on where your exposure to different currencies. So this is a profile of the kinds of risk that would be assumed, and therefore comparability analysis is let's say based on using the functional analysis as the fulcrum on the and you use the lever of comparability analysis on the fulcrum of the functional analysis. And that's how you get the set of comparables, and then you determine the arm's length price. Then we go to the tested party. The tested party, as we've seen, is the entity against whom you benchmark the transaction, or you say, this is the control transaction. I'm going to measure this control transaction against an uncontrolled transaction. And that's the essence of transfer pricing, to say how would an unrelated party have dealt with this particular transaction. And so you take the party whose functions are less complex, which does not own significant intangibles, the result of which can be verified using data that's available in the public domain. And it could therefore be the local entity, or it could be the foreign entity. Not everything has a tested party. So if you're determining interest rates on a loan, for example, then you might use the transaction itself as the basis of the pricing. So you say, a controlled party has given another controlled party a loan at LIBOR plus, let's say, 100 basis points, and you're comparing that with what would have been the transaction in the public domain, then there's no tested party. You just take what do uncontrolled enterprises transact at for comparable loans, and you get those kind of loans in the database. And using the database, then you, Bloomberg, for example, or NSDL, you would be able to determine whether the LIBOR plus 100 is an appropriate interest rate between uncontrolled parties. And then we have the comparable companies, which occurs through database screening, quantitative screening, qualitative screening, and the final arriving at a final set of comparables. This is a fairly intensive process, and most of this goes into arriving at a set of comparables from the database, and then applying the filters as we've seen, then looking at what you get after the quantitative screening through to look at whether the profile of those comparables is similar to the profile of your tested party, in order to then arrive at the final set of comparables, and then you maybe measure their profit levels to determine whether they stack up against your profit levels. Finally, we'll take a peek at the dispute prevention and resolution mechanism. I know we're conscious of time. So there are the process of dispute resolution is because transfer pricing is a very contentious topic. As we've seen, it's highly fact intensive, and therefore there can be a number of reasons why disputes arise. Most of them arise due to math. They arise because there is a choice of the method, a profit level indicator. Now, these are largely math related. They could also arise because of fundamental issues like, are you creating an intangible? And is that intangible being compensated? And this is particularly true of advertising, marketing, and promotion. When we speak of the first three topics, they are really about, is the price right for the value that is being created? In the context of AMP, it is that, are you creating an intangible that's not sufficiently rewarded? And then it could be in the case of royalties or service fees, in the sense that, are you paying too much for either something that's provided to you as technology or brand, or are you paying too little, or are you receiving too little for services that you might render? So all of these could be reasons why transfer pricing becomes highly contentious, because it's all about perception, and it's all about what is value in the eyes of the beholder. And as we've seen, because comparability analysis is about comparable X, Y, Z versus comparable A, B, C, it can be a highly dispute ridden type of a environment. And that's the reason why there are multiple avenues to address controversy in the areas of transfer pricing. So one is the fact that you follow a domestic process, and the domestic process is, as you may be well versed with it, you go through a assessing officer, or what is conventionally referred to as a specialist transfer pricing officer, who then you escalate it to the Commissioner Appeals or a dispute resolution forum, and then it goes through the judicial process of a tribunal, High Court, and Supreme Court. There are other international forums that you can follow. One of them is a mutual agreement procedure. The other is a advanced pricing agreement. Advanced pricing agreement can be unilateral or bilateral. And then there are prescribed safe harbor rules, which essentially provide some reference points to say, if you're doing an IT service, you can mark it up at 17%. If you're doing a knowledge process outsourcing, you can mark it up at anywhere between 18 and 24%. If you're providing loans, then it can be priced at, let's say, SBI base rate plus 250 basis points. So there are safe harbor rules like that. But why? But what is relevant for us is to spend a couple of minutes on why this is why do we invoke the treaty? As you would recognize, a transaction happens between two countries. And when it happens between two countries, and think of a case where India is a provider of software services to another foreign jurisdiction, let's say the US. And India provides these services at cost plus, let's say, 14%. What the Indian revenue argues is that, oh, it should be cost plus 20% because India wants 120, you've realized 114. Now, on the other side, US has paid 114 and claimed an expense of 114. And India is now saying, no, but it should have been 120. So that means you're getting 6 rupees more in India to be offered to tax. But on the other hand, those 6 rupees are not something that the US has claimed as an expenditure. It's only claimed 114. And so that becomes double taxed income, as it were, because India is paying tax on 120, but the US has claimed as an expense only 114 instead of 120. And therefore, to resolve this dispute and to get double tax neutrality, you go into a mutual agreement procedure or potentially an advanced pricing agreement, so that you might end up at, let's say, India withdrawing an adjustment of, let's say, 3 to end up at 117, and the US giving a credit for or accepting a additional allowance of 3 to end up at 117. So the US claims 117 as being a cost. India recognizes income of 117, and that thereby you've achieved the elimination of double taxation. And that's why so much of transfer pricing is about elimination of double taxation, in addition to achieving the right amount of profit in each jurisdiction. We'll spend a minute or two on the interplay. I know we're out of time, but just to say that documentation of the transfer pricing policy has effects on a string of other related legislation, particularly the related party policy in the context of company law, section 188 and SEBI LODR, as also accounting standards that requires you to disclose related party transactions. Customs valuation, as we've seen, customs looks at it from the other end of the spectrum but applies a similar set of methods, particularly in respect of tangible property and any intangible property that is conditional to the tangible property. And finally, all of this results in intercompany agreements, but not to forget that conduct is more important than contract. But yes, the essence of a arrangement is in the intercompany agreement, whether it is oral or it is written. But more often than not, it is written, except that sometimes you do find differences in conduct and contract, and therefore it's important to harmonize policies, customs valuations, and intercompany agreements so that you present a consistent set of facts to the regulators. Finally, a word on profit of attribution of profits. This, in a sense, is just an extension of transfer pricing. It applies to the extension of an enterprise in another jurisdiction. There are formulaic methods. India's a votary of the formulaic approach to attribution of profits, although the OECD contemplates using the arm's length principle even for attribution of profits to PE. It's a fairly dense topic, but suffice to say that the principles of transfer pricing could potentially apply to attribution of profits to a permanent establishment as well. With the only caveat that given that we are talking of attribution of profits, we are saying that if there is a foreign entity that has a presence in India, not through a vehicle such as a separate entity, but through its own vehicle, then a portion of that entity's profits need to be subjected to tax in India, and it's only a matter of how much, rather than if at all. And so that is, in some sense, a tangential subject relative to transfer pricing, but still inherently a part of the transfer pricing body of knowledge. So with that, I know I've exceeded some time, but happy to take questions, and I hope that this has been illuminative to some extent.
So we are very well within time. Thank you so much for the immensely insightful session. I can't thank you and Karan enough for this session. I believe everyone from the audience would agree that this has been a particularly useful session for us, all of us at CCIT. I would like to open the chat box for all the audience to put in their questions. We will wait for some questions, sir.
We have a question from Akanksha.
Thank you so much, sir, for the session. As someone who has keen interest in tax, I've always found transfer pricing to be very confusing, but your session was definitely very helpful. I just had a general question regarding how transfer pricing policies are currently being applied. Like with the changing economic circumstances, what kind of challenges will businesses face with regards to their transfer pricing policies? And how will they adjust to the perverse patterns of profits and losses with such limited comparables in the existing economic changes?
So I think it's a fair question in the context of very complex transactions, but that's also the reason why we refer to the use of the tested party and taking up an entity that has simpler functions and simpler profiles in order to arrive at the transfer price. So let's take a case of, let me give you an example in the real world. So Nike and its distributor entity in India. So there's Nike in the US and Nike in India. And what Nike does in the US is, just for example purposes, let's say it is the designer and the manufacturer of sports gear, which is then exported to India as a distributor, and the Nike entity in India is distributing the products of Nike and propagating its brand. Then what you would do is you would say, well, Nike in the US is far more complicated to determine whether its profits are appropriate, but you can determine if you were a distributor, an unrelated distributor, how much profits you would expect to get. So then you look at Nike India as the distributor entity and look to get comparables of similar distributors. Now, distributors you would get of similar product profiles, not necessarily the same brand, but you would look to anybody who's dealing with sports apparel or just apparel and equipment such as all kinds of footwear and sports gear, and look at those companies that do distribution activity with respect to apparel, and then say that what kind of a profit do these companies make, and then does Nike India make that level of profitability? You could of course apply some filters. You could apply filters like saying what is the ratio of selling, distribution and general expenses over sales that other comparable companies have relative to Nike India. And if Nike India, for instance, has selling, general and administrative expenses in the nature of, let's say, 30% to its sales, then you look for comparable companies that have similar nature of selling, general and admin expenses, and then say that these comparables seem to be an appropriate basis for me to determine the price of purchase of goods by Nike India from its parent company. That in turn forms the basis of determining what's the profit, because the profit then leads back to the price. And so once you determine that the profit level of these uncontrolled distributors is, for example, 5.5%, then you say, okay, so Nike India should make a profit of 5.5%, which means it should purchase its products so as to leave behind a profit margin of 5.5%. So a lot of it depends on what entity you take as being the tested party and how you are able to make it simple for you to arrive at comparable entities.
Right, sir.
Sure.
You make it sound a lot easier than I'm sure that it's much more complicated, because I've looked at a transfer pricing study and only one in my internship, and I found it very confusing. I just had one more question. You were giving examples of different kinds of instruments, or it's not just companies being sold or mergers and acquisitions taking place. Like there are more complicated transactions being taken place, like intellectual property. So when it comes to intellectual property and transfer of intellectual property, there are a lot of variables that come in. So how would a transfer pricing of those kind of complicated transactions take place? If you could just give a brief on that.
Sure. So maybe I'll spend a couple of minutes saying how you dissect the transactions. Here, transaction, and let's take, for example, the manufacture of Toyota cars in India. Toyota Kirloskar Automobiles Limited is the producer of Toyota vehicles in India. And what they do is they purchase raw material and components from, let's say, Toyota in Japan. They also pay a royalty to Toyota in Japan. They also pay, let's say, some technical service fees to Toyota in Japan. Now, what you need to do, if you were to just look at the profitability of these, let's say, Toyota in India and say, okay, let me compare it to potentially Tata Motors and Mahindra, you'd probably get very different answers. Instead of that, if you said, I can look at what the customs valuation is for the materials and see what two comparable engines or comparable transmissions come in at for other companies. That could be one reference point that you may have. Or if, for instance, the Toyota entity in India is using castings to convert to transmissions, then you look at what two comparable castings come in at, or if you go step back, what two comparable metals come in at, and those are available prices that you would have. So that's on the material side. Then you look at royalties and you say, okay, do I get this? You would in the public domain get a set of royalty rates that apply in the automotive industry between uncontrolled companies, because companies tend to license out their intellectual property, may not be to the same extent as saying, okay, I'll give you enough technology to build a whole Toyota car, but I give you technology to be able to build, for instance, transmissions, or to build engines, or to build, let's say, some elements of the body. And so you use those reference rates that exist in the public domain to arrive at royalty rates. Then you look at technical service fees and you say, what's the basis of the charge of the technical service fee? And it might be per hour rates, or it might be, let's say, it might be per month rates, or it might be a fixed cost that is arrived at on the basis of personnel who are deployed to render those services. And then you say that, okay, so how is the costing mechanism for these services? And that answer might be, oh, we take their full cost and we apply an overhead factor, and then we apply a profit margin of maybe 8%. And why 8%? Because that's what comparable companies also do. And then you say, okay, so then I've arrived at each of these transactions separately. And on the basis of these transactions, I'm therefore doing a transactional transfer pricing analysis to be able to say that the profit that Toyota in India achieves is arm's length, not because its absolute profit is at arm's length, but because it purchased the materials at the right price, it paid out a royalty at the right price, and it paid out technical services at the right price. And therefore, irrespective of the profit that it arrived at, those individual components of transactions were rightly priced. So you can do a transactional analysis, or you can do a profit analysis depending on the facts of each case.
Right. So from what I understand is that we have to look at the underlying tangible asset as well on which the intellectual property is based on. And then you go about doing the transfer price. So there will have to be certain layers to the transfer pricing study. It's not just based on what is being purchased, but the intellectual property rates that are applied to it over and above the cost of purchasing the item, right?
Yeah, and that's the reason why, to begin with, we said transfer pricing is highly fact and circumstance driven, and there can't be one answer to everything. You can't expect Volkswagen in India to get the same profit as Toyota in India to get the same profit as Tata Motors in India. The answers are going to be all very different because, so for example, BMW is an assembler in India, Toyota is a manufacturer in India, and the profits therefore for an assembler are very different for that compared to a manufacturer.
Got it. So thank you so much, and thank you for this very insightful session.
Welcome, Akanksha.
I guess Isha has a question. Is Isha here?
Yeah, hello, I'm there. Am I audible?
Yeah, perfectly audible.
Yes.
All right. Firstly, I would like to thank Sir for such an insightful presentation. I think as Akanksha also mentioned, I've never really gotten quite a hold of transfer pricing, but I think today's presentation made it really clear for all of us and simplified everything. Sir, my question is, so in December 2021, the RBI released a circular which replaced reference of the London interbank offered rate to alternative reference rates. So, so how precise and effective can the use of a regulatory ceiling from the RBI be on something as specific as pricing, say?
So there is a regulatory overhang on transfer prices. This we see sometimes in the context of LIBOR, or in other words, financing transactions. You also see it in the context of pharmaceutical industry, where you have, for instance, the drug price control order that deals with the prices at which drugs can be sold in the open market. So think of an Abbott that is buying from its group company in Germany and selling in India. Obviously, it has to adhere to the prices that are under the drug price control order. So you can't obviously go above an RBI ceiling, and everybody else is operating in similar circumstances as the RBI ceiling applies to them as well. So the way to look at it is to say, okay, therefore I look at comparable transactions in India between parties that have an Indian counterparty, and because then they will be subject, let's say it's an Indian borrower, and the Indian borrower is going to be subject to the same restrictions on exchange control as any other Indian borrower. So you look at making sure that in the comparability analysis, you are looking at Indian borrowers as being the counterparty, and then determining whether those interest rates are appropriate, because then the RBI ceilings will apply to everybody. But it is true that the RBI ceiling is inclusive of withholding tax as well. Sorry, I think it's exclusive of withholding tax. So you can have a withholding tax that's a top up on top of the RBI ceiling. So the RBI ceiling is effectively what you pay out net of withholding tax. To that extent, there is a top up effect of the withholding tax, but only to that extent you get a top up effect. For all practical purposes, the all inclusive RBI ceiling therefore does apply to all Indian borrowers.
All right. Thank you so much, sir.
Right, Misha.
Anirudh, you may go next.
Yes, thank you. Good evening, sir. Thank you for the enlightening session. I'll proceed to ask my question. So the OECD public consultation document goes on to state that taxpayers can make use of mechanisms available to avoid future disputes in relation to the application of Amount B through advanced pricing agreements. As a signatory to the two-pillar solution, India will be required to appropriately implement these rules in its domestic law, which will require concomitant modifications to the scope of extant APA rules as well. So, given in light of this, and given the slow pace of current APA disposals, which also includes APA renewal applications, can it be said that there is a strong case to push APA signings by creating additional capacity for the program in the coming budget? If yes, what steps can the CBDT undertake to fast track the process?
That's a fair point, Anirudh, and you should expect to see, we'll all sort of wait to see what the budget has in store for transfer pricing. Hopefully there's something on the capacity front. But it is true that the APAs, the administrative machinery of APAs has been somewhat of a bottleneck, largely because of a hierarchy and also because of a limited number of people who are part of the operating construct of the APA machinery. What is important is that if we get more throughput through the addition of more hands on deck, as it were, more commissioners who would declog the system, maybe an additional principal chief commissioner, then you could expect to almost double the pace at which APAs are progressing. At one point, APAs would take about 1.5 years at the early stages of the APA program. Today, they take 3.5, 4 years, sometimes even more than 5 years, which is the whole lifetime of the APA. So it's a fair ask that there is a need to augment capability or capacity in the APA machinery. But it is also the hope that, given that the government has recognized that there is a significant pendency in the APA system, one could expect to see some mechanism, either by way of allowing more companies to come within safe harbor and therefore declogging APA, or just building more capacity in the APA system, which of course doesn't require amendment of law, but requires just more capacity to be put into the system to enable more APAs to be concluded. So it's something that has been pending for a while, but has also been on the minds of the authorities, because they've seen a significant APA buildup, and that's not good from an FDI point of view.
All right, sir. Thank you so much.
Krishna, you can go next.
Yes, good evening, sir. Thank you so much for your session. As somebody who's relatively unacquainted with transfer pricing, I have a delightful sense of clarity after this session. So thank you so much for that. My question is, owing to LIBOR's discontinuance after the circular released by the RBI in December 2021, since ARR has replaced it, what could be the possible benchmarking implications? If you could speak a little bit about that, please.
So we would tend to use the base rate, but we also have to be cognizant of what is the currency in which the transaction has taken place, whether it's a borrowing transaction or a lending transaction. Remember, all of this is going to be international transactions, so they're all going to be in different currencies. And to this end, there is a chapter that has been released, which is chapter 10 of the OECD guidelines on financing transactions. Remember, financing transactions are not just lending transactions. They also extend to guarantees. They also extend to cash pools. Cash pools are not prevalent in India so much because of exchange control. But the short point is that you have to look to what is the currency in which the transaction takes place, and then determine what is the appropriate benchmark. It could be the SOFR. It could be essentially an overnight rate as opposed to the interbank offer rate. And the SBI PLR, it has been replaced now with the base rate, but that applies to rupee payments. In other words, if Indian entities make loans outside of India to, let's say, their subsidiaries. But short point is, use the currency as the basis of the benchmarking. And I'll also turn to Karan. He's got some experience with other cases involving currency changes where we've used this argument, and the tribunals have provided this guidance. So Karan, do you want to talk a little bit about what that means for different currencies?
Yeah, so I think you can refer to the cases of Cotton Naturals, and then there is Vena Energy cases, which has been actually handled by Suchint only. So the principle is very clear in that, that if the transaction is in INR, then the rate should be SBI PLR. And if it's in foreign currency rate, then it should be LIBOR rate. But now with the new changes with LIBOR rate, I don't know. So it's majorly if the transaction is in INR, it should be in SBI PLR. So that is accepted throughout the different ITATs and ICOTs.
Sir, we have a question in the chat box from Drishti. Hi, sir. Thank you so much for this insightful and much needed section. Can you comment on how effective the dispute resolution mechanism is in India when it comes to TP disputes?
So while there is room for improvement, as in with dispute resolution, as there is with most other things in India, you could keep going on with what could be better. I think India has come a long way on the dispute resolution side. When you rewind back to, let's say, 2012. The advanced pricing agreement mechanism, the safe harbor mechanism, the mutual agreement procedure mechanism, the dispute resolution panel mechanism are all various ways to alleviate transfer pricing disputes. And everyone recognizes over time that they are highly fact intensive, and therefore more mechanisms to get to a situation of being able to resolve double taxation, the better it is. Certain mechanisms are unilateral. Safe harbor is a unilateral mechanism. The dispute resolution panel, it has not been all that effective, but is still a unilateral mechanism. mutual agreement procedure and bilateral advance pricing agreements are bilateral procedures with a view to specifically avoid double tax. Obviously, and it in a way is it goes without saying that when you have bilateral procedures, they tend to take more time than unilateral procedures, but they're also more sustainable. They give you effectively neutrality from double tax. And so therefore, it's a matter of which process you follow. Again, if you believe that litigation is the way to go because your case is fundamentally strong, you might essentially be able to overturn the entire TP adjustment. And that happens in 80% of litigations, they go in favor of the taxpayer. And that means that the question of double tax doesn't even arise. So it's also a matter of strategically understanding and adopting the relevant dispute mechanism to or prevention mechanism in relation to the specific transaction or issue that's the subject of controversy.
Sachin, talking about dispute resolution and especially, the changing economic circumstances, do we see a shift, in the kind of disputes that we see with tax authorities going forward, especially in India?
See, we have to appreciate quickly that transfer price, that disputes in India that emanate from in relation to income tax are both in the nature of corporate and international tax as well as transfer pricing. When it comes to transfer pricing disputes, again, as we've seen, they are a combination, or they can be a combination of arithmetic and mathematics and comparability analysis and the finer aspects of intangible property or services. And when we deal with services or intangible property, there is a corresponding interplay with, say, Section 37 around deductibility. And so, or for instance, if we deal with intangible property, then that of withholding tax. So when it concerns the pure aspects of comparability analysis in the context of services or purchase of tangible property, those are far more easy to deal with because they are pure merit matters, whereas the ones that require more careful consideration, and that's the one that get more thorny, are the issues that deal with intangible property, services, financing transactions that also have a corresponding income tax element associated with them. And therefore, you might have to adopt possibly a dual approach like an advance or like an authority for advance ruling or the board of advance rulings in tandem with an advance pricing agreement to resolve disputes involving both income tax and transfer pricing. Again, permanent establishment matters have both an element of income tax as to the existence of the permanent establishment and then the attribution of profits to the permanent establishment. So I think that as you point out quite rightly, the existing set of transfer pricing issues that began with fairly simplistic ones continue, but more emerging issues concern intangibles and services and financing transactions, and that's a global phenomenon, and those are the ones that are particularly hard to resolve, also because they often enough are not resolved simply by the use of comparability analysis, but may involve application of the profit split method. And that means that you're taking something out of the global profit pool of an conglomerate and then saying a portion of it has to belong to India. And then when you do that, you're also going to have to deal with corresponding income tax characterization issues. So it is true. It is getting tougher. But then again, we also have other emerging aspects such as the global minimum tax that's coming up, which may be in some sense a counterbalance to transfer pricing problems of just profit shifting.
Rightly. Yeah. Thank you so much.
Since we have come to an end of this wonderful session with an equally interactive Q&A session, I would like to thank Mr. Majumdar and Mr. Karan for taking out time to deliver this wonderful session. I would now like to thank our wonderful director, Professor Kriti Chawla, for also enriching our session. And I would also like to thank everyone at CCIT who took time to join this session. Thank you so much. Over to you, Professor Krithi, if you want.
Thank you so much, Suchin. Thank you so much, Karan, for such an insightful session. While going through the session, I was just thinking these are such technical, components to it, talking about why a tax treaty is invoked. And, you gave such a brilliant example that made it all, so simple for all of us. Thank you so much.
Thank you very much, Kriti, for the opportunity. And I must thank Karan for a lot of the contribution to the content. I just delivered what he had developed. So thanks to Karan as well. We would, in fact, for that matter, would have liked to be in CCIT in person, but that's for another day. But thank you so much for this opportunity. And I'm glad that hopefully everyone's got some takeaways from this.
Thank you so much. Looking forward to the next one offline.
Yeah, I'll be happy to be your guest.
Thank you so much. Thanks a lot, Karan.
Thank you. Thank you, everyone.
Thank you very much and have a good evening and a happy Republic Day.
Thank you so much to you too.
Thank you so much.
Thanks, Aditya. Thank you, team.